Hello everyone. Thank you for joining today's webinar. Today's topic is Regtech powers making compliance scalable for Fintechs in APAC. This webinar is co-hosted by the Fintech Association of Hong Kong and Accuity. My name is Irene Lee, Compliance Director from UBS, and I'm also the Regtech Committee Co-Chair at Fintech Association of Hong Kong. I'm very glad to be the host of this webinar today. This webinar composed of 4 sections. Vincent Goodell from Accuity is going to share about the year 2020 sanctions landscape and the gaps in current screening process. Then we have Eric from Mossbank who will talk about how to set up an effective and efficient screening process to balance the risk versus client experience. Followed by an exciting panel discussion where our experts from UBS, Steptoe and Johnson, on-chain custodian and Accuity are going to discuss about how to mitigate sanctions, AML risk in payment transactions. We will end the webinar after a Q&A section from the floor. Now, I would like to pass the floor to our first speaker, Vincent Goodell from Accuity. Vincent, over to you.
Thank you, Irene, for the introduction. Hello, everyone, and thank you for joining. My name is Vincent Goodell, and I'm a compliance expert for Accuity. Before I start talking about sanctions and talking about the sanctions landscape and the gaps in the current screening processes, I just want to introduce myself and introduce Accuity as well. So I've been working for Accuity as a compliance expert for about 3 years now. And before that, I've been in the compliance industry for about 6 or 7 years in various positions, but always with a focus on financial crime and financial crime compliance. Now, for those of you who are not familiar with Accuity, let me introduce the company very briefly. So Accuity is a global provider of financial crime compliance solutions. We are the leader in sanction screening solutions, and we provide a variety of screening capabilities and a comprehensive list of sanctions lists to capture all sanctions regulations. Now, let's start with the presentation for today. And as we start, I think it's important to start with some context. International sanctions are a popular tool, and it's being used increasingly by governments and international organizations to address international issues and promote some particular foreign policy interests. Sanctions regulations come from many directions and pose a variety of challenges, but everyone in the industry is aware of the particular importance of US sanctions. Under the Trump administration, the US has deployed a variety of sanctions. Alone, the US withdrawal from the nuclear deal with Iran translated into more than 1,000 of sanctioned entities. All in all, the OFAC list of sanctioned entities grew by more than 50% over the past 4 years. It's now about 4 times larger than the UN list. And it's a meaningful figure to illustrate the use by the US of unilateral sanctions on many international issues, such as Iran, Venezuela, or Syria, for example. Now, regardless of any political considerations, more sanctioned entities to screen against means more alerts to review, and that's a really significant challenge for compliance. The second important trend is related to the fact that regulators update their lists very frequently. It is what we call the velocity of sanctions, and this trend has continued throughout the pandemic. Again, this trend has operational consequences. As regulators have strong requirements for sanctions to be implemented in a timely manner, frequent changes mean operational burden for preparing new versions of the list and performing additional screening controls. And for organizations that use several lists, this task can consume a significant amount of resources. Finally, a critical trend in the recent years has been the increasingly long arm of US authorities. The implementation of secondary sanctions is a prime example for that, with the US authorities basically requiring all entities worldwide to comply with their sanctions. but the US is also using a range of factors to look for US nexus in a transaction. These factors are translated into aggressive enforcement actions against a range of different entities. As a result, many companies are facing a regulatory burden and are basically fearing US authorities, or at least they are carefully assessing their exposure to sanctions risk from the US. Now, that was for the general trends, but looking closer at Hong Kong, there are a variety of recent developments in the context of rising tensions between the US and China. To some extent, you could argue that Hong Kong is caught in the middle of a perfect storm. So before I go over to some of the key recent developments for sanctions in Hong Kong, I want to pay a tribute to Mr. Nicolas Turner, who is on our panel today. Through his weekly sanctions summary, Nicolas shares his expertise on the key sanctions development and provides spot-on analysis. So it's definitely a must-read for me, and I encourage everyone to subscribe to his mailing list. Thank you, Nicolas. Now let's look at the recent developments on the US side first. There are, first, sanctions that are imposed against China in general and that are not specific to the situation in Hong Kong. These sanctions include the recent investment ban on some Chinese companies that were identified as linked to the Chinese military. In a variety of cases, the US also designates Chinese entities as part of other sanctions programs, such as Iran sanctions or North Korean sanctions. And finally, as a response to the situation in Xinjiang, the US have used Magnitsky sanctions, which allow for blocking sanctions where serious human rights abuses are alleged. These sanctions can have far-reaching effects, especially when imposed against entities like XPCC. Now, looking at Hong Kong-related sanctions, there are currently 15 individuals that are blocked under Executive Order 13936. These individuals were identified by a US report to have played a key role in the implementation of the national security law. And a new round of sanctions is expected in the coming weeks. That round should target the financial institutions that have been involved in significant transactions with those 15 sanctioned individuals. Now, what's also interesting to look at is the Chinese reactions to those US sanctions. On several occasions, the Chinese authorities announced sanctions against US officials, but the actual actions were very limited in reach to this point. Also, looking at the recent statements from the Hong Kong Monetary Authority related to Hong Kong sanctions by the US, the HKMA did not seek to block the effect of US sanctions, but instead advised all authorized institutions to carefully assess all risks involved and hand over to treat all customers fairly. Finally, even if Chinese regulations have been mostly reactive to date, the recent publication of China's new export control law could be announcing more restrictive measures from China in the coming years. To conclude on the landscape, the coming weeks and months will likely be intense and bring plenty of interesting developments. It's always tricky to make predictions, but there is little doubt about the fact that there will be intense sanctions activity from the US with the last few weeks of the current administration. And many experts expect that there will be significant developments on Iran sanctions and on China as well. Now, on the other hand, it's not anticipated that the Biden administration will bring a significant shift in the US policy towards China. And finally, one area of development to watch could be the Chinese increasing use of sanctions through its new export control law first, but possibly also through additional legal mechanisms. So we have seen some of the main trends in the area of sanctions. Now I'll be looking at sanction screening and share some of the key challenges and gaps related to screening controls. So first, screening is the key control for sanctions compliance. However, there are various industry developments that can make these controls more challenging. The first area that I want to mention are domestic payments. Domestic payments represent the bulk of payment transactions, and sanction screening is typically not required by regulators for these transactions. Now, we observe a growing tendency for global banks and others to include domestic transactions to their screening controls. And there are several reasons that explain this decision. First, it should be clear to every institution that when you don't screen domestic transactions, you are basically relying on your counterparty to have performed adequate screening on their own customers. But relying on a third party shows its limits for the following reasons. First, the counterparty may not be screening against the full set of sanctions lists to which your institution is subjected to. And also, the other institution may not have implemented adequate controls, it may not have the latest list, or it may have overlooked some alerts or some risks. And therefore, relying on your counterparty for sanction screening is a risk. And that is why some institutions now choose to perform these controls themselves. The second area that puts challenges on sanction screening controls is the acceleration of payments. Instant payment systems are already a reality for domestic payments in most countries, but we are now observing an acceleration of cross-border payments as well. The SWIFT GPI system is a prime illustration for that. And whether it's a progress from a product standpoint, it does raise the challenges to detect and remediate sanctions issues as rapidly as possible. And finally, I want to share a few words on virtual assets. This is an area of very rapid development. The FTAHK standards have clarified compliance requirements for these activities, and the transparency of virtual asset transactions is one of the key requirements. Hong Kong has recently launched a consultation for the introduction of a specific license for virtual asset service providers. But ultimately, the screening of virtual asset transactions remains an open question. There is currently no SWIFT-like infrastructure for virtual asset service providers to exchange that information about the sender and the beneficiary of a transaction. And the industry has recently come up with a shared data model to exchange that information, but the underlying infrastructure is not there yet. Now, to conclude my introduction, I wanted to talk about screening controls and share some of the key gaps that have been observed by regulators in the recent enforcement actions. So the first area of gaps is related to stripping practices, which basically corresponds to fraudulent manipulations of payment messages in order to avoid detection. These patterns are still observed and frequently include global financial institutions. As key mitigants to such practices, it's important to implement robust internal controls through distinct and independent control lines, and also to consider specific capabilities that can detect such fraudulent actions. The second area of gaps is data. And gaps in data include both issues with watchlist data and issues with internal data. Regulators have noticed that institutions have failed to include and use all relevant lists for screening, and also that institutions have failed to implement new sanctions in a timely manner. As for the internal data, some institutions have poorly designed their screening controls and failed to include all relevant counterparties and all relevant identifying information in their screening controls. And all in all, these gaps related to the data call for a thorough sanctions risk assessment and for comprehensive testing processes. Now, looking at the tools themselves and the matching logics implemented, some gaps were identified as well. These are both gaps related to the actual matching logics, where the filters don't raise all relevant alerts, but also situations where the screening tool's performance was inadequate. Timeouts could cause inaccurate detection. These gaps, again, illustrate the importance of testing, but they also illustrate the importance of tuning your screening tool so that all relevant alerts are generated. Finally, once these alerts are generated, the resolution processes must be well implemented as well. One area of gap was related to inadequate alert resolution processes. The issue was a lack of documentation and a lack of training in the organization, which in turn resulted in errors in the investigation of alerts, as well as an overall lack of justification for closing an alert. So there are a variety of issues to look at, and that's why it's important to review those enforcement actions. On a final note, implementing sanction screening control is an ongoing task, and as such, it requires continuous improvements. So that's it for me. Thank you for your attention. Feel free, if you have questions, to reach out to Accuity in general or to me personally. You can look me up on LinkedIn. So that's it for me. Thank you again for your attention. And moving on to Eric's presentation from Moxbank. Thank you.
Thanks, Accuity, for the invite. This is Eric, Head of FCC Controls in Mox. I'm the Certified Public Accountant, Certified Anti-Money Laundering Specialist, that means ACAMS, and also Certified Anti-Money Laundering Professional in Hong Kong. I've worked in financial crime compliance industry for more than 10 years, covering various roles, including advisory role and transaction monitoring as well. Before joining Mox, I was the FCC Digital Lead for Retail and Wealth Management in HSBC for Asia Pacific. And PayMe was one of the biggest projects that I have worked for at that time. As you know, Mox is a Hong Kong virtual bank owned by Standard Chartered, PCCW, Hong Kong Telecom, and Trip.com. We have launched in September this year, and our mission is to help everyone in Hong Kong grow your money, your world, and your possibilities. To achieve that, you can actually open an account in minutes for free. Actually, it can be as fast as 3 minutes, and earn your interest every single day and enjoy the 5% super cashback on funding merchants or 1% unlimited cashback on all merchants. Actually, more features will be deployed to the market next year. Definitely, we treat customer experience seriously, but we never forget risk. So this is the perfect timing for me to share with you on the interactions between risk management and customer experience and how to build an effective and efficient screening system after considering the risk and customer experience. I hope it will give you some knowledge of the relevant screening requirements in the coming 15 minutes. As the time is limited today, I will only cover 4 key items in the coming 15 minutes. First of all, the regulatory requirements on screening, and then which key screening components we should consider, and then the impact of the false positive of total screening alerts, and last but not least, we'll share some insights on what can we do next through machine learning. Okay, for the regulatory expectation, here I will just code the key requirements in relation to screening imposed by the Hong Kong MA only, as we are focusing on the Hong Kong markets. According to the Hong Kong MA AML/CFT guideline, the authorized institutions that record AI should maintain a database to identify sanctioned or designated parties and establish an effective procedures to identify if the customer is a foreign PAP and perform adverse news screening before establishing a private banking relationship. Based on these requirements, you can have a sense that what you need to consider when you build your own screening system and your own screening process. 3 components you should consider in the screening system: database, screening logic, and algorithms, or screening setting, we can say. Here, I want to briefly discuss on the database first. If you remember what the Hong Kong MA regulatory requirements are, the AI should maintain a database to identify sanctioned parties and foreign PAP, and adverse news for private banking relationship. So when the AIs build their own database, they should consider which screening lists should be included in their database. For the database, it can be divided into 2 categories: external lists, which can be obtained from the external vendors like Accuity, and internal lists, which should refer to the AI's own risk appetite and put the prohibited customer names or bad list names into their own internal list. In details for external lists, you can further divide into sanction lists, for example, the list from FTAHK, United Nations, EU, or Hong Kong MA, depending on your market. And also PAP lists, It can be foreign PEP or domestic PEP, or adverse media news as well. This list will form a foundation of your screening database. After building the database, AI should also consider the screening logic and setting. It means whether to deploy FTAHK logic or exact name match when screening customers against the database that we just discussed. In addition, a couple of screening settings you may need to consider as well, including the date of birth match setting and location match setting. Regarding the date of birth or the location settings, since the information of some hits on certain individuals may not be always comprehensive enough. For example, the database may only contain the year of birth, which may be calculated based on the age of the certain individuals from the news or from the external list. Then it may be a chance that the calculated year of birth may have 1 year gap of the actual year of birth. The AI should consider their own risk appetite when setting the relevant screening logic, including date of birth and location match setting. After building the database and deploying the setting that we discussed, it is not the end of the story, as we also need to think about how to handle the screening alerts in an effective and also efficient way. There are two key things that we need to consider as well: a proper platform to perform alert review, and it will be nice if there's a maker tracker function with a QA functions, which can be performed by different independent persons on the alert handling platform. It is important as all of the viewing evidence can be stored on a single platform to show like auditors or regulators easily. Other than that, a proper MI reporting functions is also required as well. It will definitely save your time to prepare the MI report, and then it is easier for you to submit to your management to review and identify the risk areas. Such MI report not only cover the figures of outstanding alerts or completed alerts, this is the basic, but also be able to generate a report based on different category of the database and agent of it, so that you or the AI can look at the risk easily and handle the risk easier. We just walked through the topic on how to handle alerts and how to prepare the database and deploy the setting. And if you are part of the industry right now, I mean the FTC industry, you must have a question in your mind. We have so much false positive. We have so much noise generated from our screening system. What can I do? I know that this is one of the pain points of the industry around screening, as we want to contain the risk. We want to set the risk as low as possible, but at the same time, we also want to have a better customer experience. It's like how to balance the risk and customer experience. This is the topic that we are all facing. If there's too much noise, definitely it will have a volume pressures on our people, on our capacity, and also have a negative impact on the straight-through process rate, especially for the e-onboarding channel, like VB. For example, when customers submit an account opening application through our MOX app, we are not able to onboard them immediately if there's an alert generated on screening. It will be definitely a bad customer experience. Even worse, the bank are not able to focus on the real risk alerts when there are too much noise. So the impact is actually huge. It's not only that have a negative impact on the risk, but also the customer experience. However, no worries. I'm going to share some tips that the bank or the AI can consider to reduce the false positive rate. First of all, you can think about which list you should use for onboarding and which for periodic screening. As usual, the external vendors have an extensive or comprehensive list available for their clients. Not all of them are required for onboarding or periodic actually, and not all of them are required for your market. So you need to think about which list you need to pick, and then which one is appropriate one for you to follow based on the regulatory requirements that you are subject to. Secondly, are all lists required for fuzzy logic? Anyone that exact match can be deployed for certain lists? Thirdly, are all lists applied for the same screening setting we discussed just now? Is one-size-fits-all approach appropriate for all lists? Last but not least, try to send customer data points as many as possible to your screening system in order to reduce the false positive. All of these ideas are up to your own risk appetite. I cannot provide you a concrete answer, but what I can assure you is that from the slide that you can see, the solution box is bigger than the pain point. It's not a design problem. It is intended to show you that you can always find more solutions than problems. After considering all of the points that we mentioned just now, I'm sure that we cannot reduce all of the noise or all of the false positive rates to be zero. So we should also consider taking one more step by deploying the Regtech to help us. This is the hot topic in the market right now. So machine learning can be one of the ways out to handle the false positive alerts. Machine learning can keep learning from the human decisions on why to cause these screening alerts, and then when there are sufficient learning data or sufficient decisions made by the humans, then the AI or the bank can try to deploy the alert reviewing functions on the shadow mode first to ensure that the alerts can be reviewed properly before auto-decisioning or auto-discounting on the alerts without human interventions. In this stage, in this shadow mode, human effort is still required because we have to ensure that the accuracy of the decision made by the machine learning on the shadow mode. After a certain period of time, when everything is fine, all of the error that we have potentially identified is fixed, then you can put it into production environment with proper governance. That means you have to define your risk, submit to your the top management team to review. Of course, certain controls should be in place to ensure that the decisions are accurate. For example, the certain volume of QA should be done after the machine learning in place, and also regular review on the machine learning logic, etc. This is the way forward to reduce the false positive and also increase the STP rate, the straight-through processing rate for onboarding. So it sounds like a win-win situation for risk and also for the customer experience as well. So definitely, this is something that the industry should consider going forward because it can contain your risk at the same time reduce your headcount, but also benefits for your customers. So we should definitely consider deploying machine learning on screening alert handling. That's all for the presentations. Although it is a short sharing, I hope you may find it useful. If you have any questions, please feel free to drop me a line in the LinkedIn, and I'm more than happy to share my FTC knowledge and experience with all of you. Thank you. Have a nice day.
Thanks for your time to join today's webinar with a topic about Regtech Pulse making compliance scalable for Fintech in APAC. This webinar is co-hosted by Fintech Association of Hong Kong and Accuity, and I'm your moderator and host of this panel. My name is Irene Lee from UBS AG, and I am the Compliance Director in this company and also the co-chair of the Regtech Committee of the Fintech Associations in Hong Kong. So we will be taking a time to talk about the big trends we need to keep an eye on and how it changes the world and the way how we do our business, and also to look at how the risk and compliance works in this digital arena. Before we dive into the panel discussion, I'm so excited to introduce you our three amazing leaders in the Regtech industry who will be sharing their views and ideas about this topic. We have Alexander Kurth, the CEO and co-founder of the On-Chain Custodian. And we have Neela Das, Head of Innovation of Accuity. And we also have Nicholas Turner of counsel from Steptoe and Johnson. So we have today a really good mix of reps from legal, compliance, and the innovative entrepreneur side. May I invite each of the panelists to give an intro of yourself and your backgrounds? Perhaps let's start with Nick. Over to you, Nick.
Thanks, Irene. My name is Nick Turner. I'm a lawyer with Steptoe and Johnson, which is a law firm based in Washington, D.C., but I'm in Steptoe's Hong Kong office. We specialize in advising financial institutions and corporates on compliance with a wide range of regulations, especially U.S. economic sanctions and export controls and anti-money laundering laws and regulations. I'm really glad to be here today. Thank you.
Thanks. And lady first as well, Neela, over to you.
Thanks, Irene. Hello, everybody. So I'm Neela Das, and I'm Head of Innovation at Accuity. You've heard from Vincent already, so you know that as an organisation, our mission really is to protect the reputation of our customers. And as you've also heard this morning, it's a really fast-moving world. So I have teams who are based around the world in our key regional hubs. And really, as innovation, our aim is to engage with our customers and come up with pragmatic solutions so that we can meet their ever-changing needs. It's a real pleasure to be here with you all today.
Thanks, Neela. And Alex, over to you as well.
Sure. So my name is Alex. I'm the CEO of On-Chain Custodian. So background in the banking and capital market industry, first at the Bank of New York Mellon and then at Swift, but over 22 years in total. And recently I moved to the digital asset and crypto space where with co-founders we've created On-Chain Custodian, who offers custody and open finance services to institutional players and sophisticated investors out of Singapore.
Thank you. So we are ready. Let's start with the first panel discussion. So when I read about different articles around the statistics and the volumes of the transactions payment in the time of pandemic, it is so interesting that I found an increasing trends of the payments processed by the digital channel, as well as particularly they also process with digital and payments on the currency as well. So what are the risks and the issues around the increased volumes around these payments? We can see that there may be some sanctions risks as well. As you know that there may be some different states, individuals and entities, they may use some policy sanction tools to process their payments and also monitor around the payments and the risks. So this question is for you, Nick. What are the risks that you think and the enforcement risks and the legal risks to the companies in Asia from a sanctions perspective when it comes to payment transactions?
Sure, this is a great question and a really important question for companies in Asia, whether we're talking about traditional financial institutions or companies that are working in virtual assets or other types of technologies. When it comes to payment transactions, what we have to keep in mind is that regulators like OFAC, which is the Office of Foreign Assets Control in the United States, will look at companies that are processing payments to determine if they're engaging in transactions with sanctioned individuals or entities, or even sanctioned territories like Crimea, Cuba, Iran, North Korea, or Syria. And when those transactions involve a U.S. person, which includes somebody in the United States, or a company which is incorporated in the United States, OFAC can bring an enforcement case. And in some instances, those cases have reached into the billions of dollars in the most serious cases, but often in hundreds of thousands of dollars in financial penalties. And that's not to mention the cost of investigation and hiring lawyers to help deal with that situation. So whether we're talking about OFAC or we're talking about local regulations and UN sanctions, it's really important for companies to be paying attention to who they're transacting with, who their customers are, and whether or not they're dealing with sanctioned territories.
Thanks, Nick. I am with you, totally agree with you. When we are as a global bank processing payments in the global cross-border aspects, we always concern about sanctions and look through the offer papers, website, and the local regulators, how they talk about in handling sanctions. And it is really amazing, costing us a lot of efforts in looking through it. So Nick, do you think that there will be a good idea to use technology or Regtech solutions to help the providers as well as the bank like us to monitor those sanctions risks? And what are your suggestions on the Regtech adoptions?
Sure. I think when we're talking about high volumes of transactions, technology is really the only solution that makes sense. And when we're talking about Regtech in particular, what we're looking to do is to achieve a balance between effectiveness and efficiency. So effectiveness in this context means identifying all of the references to potentially sanctioned individuals, entities, or territories, and not overlooking potential references. So that means having a tool which is comprehensive and well-tuned. When we talk about efficiency, that means we want a tool that's going to return the right amount of potential hits or matches so that we're not wasting operational resources on reviewing false matches or false positives. So we want to have a tool that's going to use elements like machine learning or AI or other technologies to narrow down what the human beings have to focus on. So that will help balance that effectiveness with efficiency and hopefully lower costs in order to keep the business running in the interest of the customers.
Sounds like this is a very good investment for the bank going forward as an interim and long-term solution for sanctions risk. So now we're smoothly moving to the topic about crypto and digital payments. Hey, Alex, I think this is a question for you as well. So as a crypto digital custodian firms, which is not a bank, what do you see the important or most difficult compliance or AML challenge for you to operate? And what are the suggestions for you to cope with the evolving technology and regulatory monitoring regime?
Sure. So crypto players like us, called virtual asset service providers by the FATF and more regulators, are really becoming financial institutions as a whole. Most jurisdictions around the world are establishing a regulatory framework for crypto asset service providers or virtual asset service providers like custodians, like exchanges, like brokers, asset managers, and so on and so forth. And they obviously do that very closely in relation to what is currently being done for other financial institutions. So for example, the Financial Action Task Force, the FATF, used to have recommendations for jurisdictions to implement with regards to AML and CFT, which apply to payments and other transactions by financial institutions. In June 2019, they included crypto assets or cryptocurrencies in the scope of those recommendations, which means that now, as part of regulations, financial institutions who are virtual asset service providers like us needs to comply to everything banks needs to do. For example, KYC, obviously, that's a given. So knowing who our customers are and making sure that they are not on sanctioned lists. And in this regard, using of platforms like Accuity, for example, that we're using at On-Chain Custodian is very, very critical to ensure that we scan against all the lists that we need to scan against, and it's done in the most efficient way. We also have the requirement to monitor transactions on the blockchain, and for that you have providers like Merkle Science or Elliptics who are providing chain analysis tools, which allows us to identify any incoming transactions or outgoing transactions will be involved with a wallet that has been tainted, for example, used for a hack or used for money laundering or used for a scam, either directly or indirectly in previous transactions. And finally, with the travel rule, which is a recommendation 16 of FATF, we now have to do what banks have been doing through SWIFT, for example, for years, is exchanging, ordering, and beneficiary customer information between virtual asset service providers for each transaction above a certain threshold. That's that's the challenge clearly that we have in our industry today, because not only these jurisdictions are implementing those new rules at different pace and different times as well, but also are licensing virtual asset service providers at different pace, which makes it complex for us to understand who can we still work with and who can we still transact with, and also how do we transfer that information using protocols that are currently being built. And of course there, Regtech is critical as well, with companies like Nota Bene, for example, or others who are building Regtech solutions to enable us to comply with the travel rule in the coming months and years to come.
Alex, your comments are all spot on. I think it is very difficult for a fintech company to comply with the bank regulations. So from your point of view, do you think that the current regulatory requirements, perhaps around the licensing requirement and the other compliance monitoring requirements, are up to speed or up to the speed to cope with the evolving technologies? Or do you think that it is too difficult to use conventional regulations to govern evolving technology companies? What's your view, Alex?
The best regulations are those who are not inspired from the old ones, in my view, because this industry is very specific in the way value is exchanged or payments are exchanged between the different players, in a very decentralized way. And therefore the methods of the past, in a way, or the current methods rather, or in the traditional space, are not always fit for purpose. And we've been trying to influence FATF towards being a bit more open to solutions that are more adapted to our environments in terms of achieving the same objectives that we have about preventing money laundering and preventing terrorist financing. It hasn't been always easy to do, but we do see a change. We had last week V20 conference of Virtual Asset Service Provider 20 conference at the front of the G20, where FATF was present, MAS was present, and where dialogue was taking place to make sure that the evolution of those recommendations and regulations will take more into account the specificities of cryptocurrencies and virtual assets.
Great, thanks, Alex. So Neela, as the head of innovation of Accuity, so I think basically you have spoken to a lot of different clients, banks, vendors, and regulators to cope with the evolving technologies and also the regulatory scrutiny. So can you give us some suggestion or recommendation? What's the best practice to mitigate this kind of AML risk for the fintech companies?
Of course I can. Thank you, Irene. And at the risk of stating the obvious, absolute step one is not to ignore your AML obligations or hope that somehow it doesn't apply. Whether you're supplying complex investment products or facilitating low-value transactions, fintechs do fall under the same regulatory purview as more established financial institutions. And back in the days when we could all meet face-to-face and not on Zoom, I would still meet fintechs with seemingly huge potential who had not yet invested in a compliance officer. And you could sense this hesitation that it might compromise their agility or their balance sheet. However, those are not excuses a regulator would accept. And as we have Nick on the call, I'm going to let him underline why this is really not a sensible approach.
Right. Well, I think what I can add to that is based on my experience. It's much better for a startup company to invest in compliance early on when it's still easy to bake compliance into the process. And if you wait too long after the business has grown, or even worse, after the business has attracted the attention of a regulator or enforcement agency, then the process becomes much more expensive, much more difficult, and it's harder to achieve what you want to achieve on your own terms. So if you want to be able to build a compliance program that really fits the business and which meets your needs, which is effective but also efficient, and not have to do that based on external pressure from a regulator or enforcement agency, you really need to take it on board as early as possible.
So I'm all with you. Basically, as a bank compliance officer, we always deal with the vendors and fintech companies when they recommend some solutions tailor-made for our banks. And one of the pain points is that, as you know, we actually governed by the stringent regulatory requirement. All the way we need to do the due diligence when onboarding those vendors. And the due diligence requirement could be a lengthy pages, a lot of different checklists that we need to complete by looking at the backgrounds of the company, the financial reliables about the tools, and also whether it actually cope with our long-term and interim investment developments. So it is like a pain for us to look at all those solutions as well. So Neela, perhaps you have more experience when you talk to the fintech companies. Do you see they are also having some pains when coping with the regulations? And do you have any maybe fast tips for them in order to them to well equip themselves about the regulations so that they can comply with the bank requirements, so that they can faster and quicker to adopt the Regtech solutions with the bank? What's your suggestion?
Yeah, I mean, look, there's a subtle art to this because you have to blend the qualitative with the quantitative. And in some ways, you've underlined a method that we see lots of fintechs using, which is that they work with a bank. You know, sometimes you can leverage that relationship to better understand the regulatory requirements that you might have. They can open doors for you in that sense. And also, really, the key thing is to be a part of the compliance landscape. Events and organizations like this exist. As Alex was saying, there is a lot going on where the pace of change is fast. The industry itself is leading the conversation. So by being part of that, you can get a broader sense yourself on what is required. But really, some of this is just about doing the background work. The regulator wants to see a risk-based approach. So you need to conduct an honest review. You need to speak to compliance professionals, possibly seek legal advice. And I think one of the really key pieces of advice I've once seen given is that establish those company-wide KPIs, which include compliance and risk and management items. Because if you do this, you're demonstrating how it's been embedded into the corporate culture, so that when that fintech wants to work with a bank such as yourself, they have some of that paperwork in place.
Yeah.
If I have go ahead.
Go ahead. Yep.
So I guess the one thing I would probably mention to this community, because it's a pitfall we see time and time again at Accuity, because fintechs are technology companies themselves, there is a real temptation to just build your way out of it. And the truth is, it doesn't even need to be small organizations. Some of the largest e-commerce firms in the world have found themselves on the wrong side of the regulator for putting together systems that they think meet the obligations. And what makes my job interesting as innovation actually is that in order to meet your compliance requirements, it isn't necessarily about having the smartest, fastest tech. You have to make sure the audit trails are in place. You have to make sure the reporting is in place, because at all times, actually, the focus is to demonstrate to the regulator that you have considered the risk at the whole and then mitigated the risk. And so how you make those decisions and how you document that is as important as the decisions that you're making. So please do seek advice. There's plenty of it out there, and find a way forward that is right for your organization.
I agree with you, Neela. I really love how you describe we are part of it in the community. So we are part of it in one ecosystem. So maybe let me open it up to the floor to opine on these open questions. So as a fintech and regtech ecosystem, what is the way forward for AML risk and the other opportunities? As you know that just wearing my hat as a co-chair in the Fintech Association of Hong Kong, looking after regtech, we also have a lot of dialogues with the vendor, regulators, and the bank. And we found that in this evolving culture and the technology space, we really need to talk and collaborate with each other to understand what the business needs are and where are the biggest risks. And we need to strike a balance. And sometimes we do need to have an open dialogue with the regulator to tell them, hey, where we are now, and also what's the risks are, tell me what to do. And also, please give us some accommodative, more flexible regulations so that the technology can smoothly develop on a more secure and ring-fenced environment. So somehow we do link up with the different vendors and the community to talk to the regulator occasionally and casually in a sandbox approach or in some other casual talk as well. So I think this is the way forward. But then to Alex, as a custodian on the crypto and digital assets, do you see that this is the same approach, or what do you suggest that we should be doing for the way forward in the AML ecosystem?
I fully agree with what you just explained. I think collaboration and industry discussions are key, not in a specific jurisdiction only. I think it needs to be cross-border as well. So I think it's important that the industry and the regulators have places to meet in each jurisdictions, obviously, and that's the case in Hong Kong. I know it's the case in Singapore as well. I think it's also important that at global level, the industry can meet and align on their key message to their regulators across the world, but also that regulators meet and agree on, as much as possible, similar approaches to AML-CFT and similar approaches to sanctions and other compliance matters. They do that through FATF, for example, and other forums. But I think that at the time of implementation of regulations, sometimes there are some differences between countries, which leads to a regulatory arbitrage by some players in the markets, which is never good for the same objective that we all have, which is the fight against money laundering and financing of terrorism and other illegal activities.
Agreed. So when talking about regulatory arbitrage, I think Nick is the best position to opine. So when a bank like us having a lot of global presence and global reach, when we do cross-border business outreach, we do face a lot of different jurisdiction, fragmented rules in terms of like data transmission, cloud adoption, and the like. So it is very painful for us to understand all the jurisdiction across the AML ecosystems or the other Regtech solutions. So for Nick, so what do you see the arbitrage here, and what is the pain points and opportunity for the way forward when a bank like us or the other vendors want to outreach globally on the Regtech adoption?
Well, I like to think of it in a little bit of a different way, which is a lot of companies, especially if they want to be reputable and to be real international players, I think they look for jurisdictions that have strong regulation and have clear regulation, but also regulation which is balanced against other factors like financial inclusion and innovation. And I think we see a lot of jurisdictions in Asia, particularly Singapore and increasingly Hong Kong, which are trying to achieve that balance. And I think it's really allowed them to nurture a new industry in those countries, which is very important. One thing that we have found is that companies which take advantage of jurisdictions that have, let's say, lesser regulation, they often find themselves in a position later on where they're being asked questions, maybe by a financial institution or by a regulator or someone else about some customers, about compliance controls, about suspicious transactions. And because they weren't focused on building a strong compliance program, perhaps because it wasn't demanded of them by the jurisdiction where they were operating, that can be a difficult situation to be in. And so, many companies, I think, are taking that on board and putting in these compliance processes from the beginning, making sure that they have a strong framework in place. And I think they're going to be well equipped to be big international players.
Thank you, Nick. So one of the interesting trends that I have seen is that from the HKMA sandbox statistics, actually Regtech adoption is contributing the largest numbers in the report. So Neela, what do you see that the increasing trends of this, and can you maybe suggest us one of the hottest Regtech tools for the way forward if we want to mitigate some AML risk and compliance risk going forward?
I think rather than making a direct recommendation, which I don't think is appropriate in a webinar such as this, I think actually, as someone who works in innovation, part of what I do is always thinking a step forward. So I think there is a level of understanding that in order to have an efficient system that's effective, as Nick was talking about, AI or some method of technological technique is critical, otherwise it's not operationally sane. And from my perspective, some of the things that I'm now looking at are the Singaporean principles of FEAT, where it isn't enough just to use AI. You don't have to just meet your normal obligations, such as audit and reporting, but also, is it fair? Is it ethical? Is it accountable and transparency? So I think in terms of where this market is going, the evolution of AI itself and the sophistication and our understanding of what that means for the decisions we're making is reaching a new level. And once again, it's Singapore who's really leading the way in having people think like that. So I think really from a Regtech perspective, that's the next evolution of where we go. Using AI, using technology, I think is a given. So it's about how we implement it well and ensure that it's used correctly for everybody.
Yeah, that's well said. And I think from a bank perspective, somehow we do see Regtech as a tools that help our business to run it more safely. And also, I think from monitoring perspective, we also use this tool to help us for the human decision. So this is not a replacement on the human labor, but it's more to aid us to make more smart investment or the monitoring decisions. So as a bank, I think in the coming future, we do willing to invest more on the Regtech adoptions, but then we also need to accommodate many of the controls, regulatory requirements, and so on and so forth. So I think that's all. And thanks Neela, Alex, and Nick for sharing the greatest ideas about this panel. And I hope that you enjoy this and see you. And thank you.
Thank you.
Thanks everyone for joining the panel. I hope you all enjoyed the webinar today. Let me now open the floor for questions, and let me check with the panel systems whether we have some questions already in hand. Great. It seems we have a lot of questions from the floor and the audience. It seems the audience really enjoyed the panel. So without further ado, let me bring up the first question to our honorable speakers and panelists. So the first one I have is, what is the suggestions to FI for building Regtech around in-house versus third party? I think this is also a good question from our bank as well. Somehow cost is really a constraint from a bank when investing in the Regtech solutions. So we are struggling whether we should buy something from a third party or actually build it in-house or do it in a hybrid way. As you know that banks is not a fintech company and fintech company is not a bank. Somehow we need to know what is the best way to collaborate and adopt the best solutions for the bank. So I think this is the question perhaps for Neela. As the head of innovation is in Accuity, I understand you also reach out to a lot of different banks, vendors, and regulators. How do you see the trends we have? What is the suggestion for FI like us for building Regtech solutions? Should we choose between in-house or actually buy something from a third party? What's the suggestion, Neela?
Thanks, Irene. I mentioned some of this in my talk, I suppose. There is a real temptation to just build in-house. The decision you make is yours to assess the risk that they pose. The key thing is that whichever solution you choose definitely meets all the regulatory requirements. And as I said, it's not as simple as just finding alerts. It's ensuring that you have all the evidence that a regulator might need. So ultimately, it's something that every institution has to decide for himself, or themselves. But it is. It's. I guess my word of caution would be it's not as simple as it may seem at first.
Yeah, and for Nick as well. So when the bank is deciding on whether to build it in-house or with a third party, what do you see like the legal or compliance risks that banks should be cautious with? Do you have some smart tips for us?
Well, I think Nila hit on this in her remarks. There have been enforcement cases recently where large companies, very sophisticated companies, have gotten into some trouble with OFAC for failing to have effective sanctions screening technology that is well calibrated to their particular business. So for example, there was recently an online marketplace, very famous company based in the United States, that had a settlement with OFAC involving thousands of transactions over several years. And in some cases, the problem came down to the fact that the company's screening filter just wasn't configured correctly to identify all the potential references to sanctioned parties or sanctioned countries. So it's very important if a financial institution or another company wants to try to build a tool in-house that they make sure that that tool is really fit for purpose and is going to be tuned and configured in order to be effective. Now, that being said, one nice thing about building in-house is that you are able to create workflows that really suit the business processes. And that's another important aspect to keep in mind, is the workflow and making sure that any potential sanctions hits are going to be reviewed quickly, and that you can keep a clear record of what the disposition was and the reason, and that that's going to be accessible for third parties who need to review that information in the future.
Yeah, thanks a lot. I think that's all good opinions. I think maybe in the future trends that bank could be also a fintech company where when they build something in-house, and then perhaps we can develop some hybrid models to collaborate very closely with the fintech company to build some work flow that is a very standard model for the other banks as well. So let's quickly move to another question. So in the second panel, we talk about a lot of sanctions, and it really ties back to the recent news from the US as well. So in Asia, the financial institutes are not US company, and they may not have the know-how about the US jurisdiction, and perhaps they do not really have a presence in US, and they do not process payments in the US. So the common question is that why do Asia companies need to care about the US sanctions? Perhaps this is the question for Accuity first, and then to Nick again. So Nila, over to you first.
I think it would be one better answered by Vincent.
Yeah, I can take that. I can take that one, Irene. And I think I touched upon these items in my presentation, and Nick did mention a couple of important notions as well. So I think so it's really particular to U.S. sanctions that they attempt to go beyond U.S. persons only. And so the prime example for that is secondary sanctions. And those primarily, for some sanctions measures with secondary sanctions, the U.S. authorities are requiring non-U.S. persons to implement their sanctions. That's one aspect to have in mind. But you also have that notion of U.S. nexus in a transaction or in a relationship, basically, which means that any financial institution and even non-U.S. financial institution needs to be concerned or need to take into account any potential U.S. nexus with a transaction or any activity. So there were prime examples include transactions that involve U.S. financial institutions, transactions that involve U.S. origin goods, U.S. origin technology, etc. And even in a recent example from an OFAC enforcement action, OFAC issued a penalty against a non-U.S. entity because it was using a U.S. bank to carry out prohibited transactions. And so by hiding the sanctioned entities involved in that transaction, the non-U.S. person caused the U.S. bank to engage in a prohibited activity for U.S. person. And that facilitation was the ground that the U.S. authorities used to impose a penalty on the non-U.S. So there are really a variety of ways through which the U.S. can claim jurisdiction on a transaction or basically enforce their sanctions. It's really a key aspect to assess.
Great. So Nick, do you have anything to supplement on this question?
Sure. I think Vincent hit on the key points. I would only build on them by pointing to some additional examples. So the U.S. financial system is an important nexus when it comes to sanctions for companies in Asia. But the other one to keep in mind is data. Increasingly, OFAC is focused on looking for a nexus to the United States involving data, and that could include servers that are based in the United States or data which has to be processed by U.S. companies. And there was a recent enforcement example. It was an interesting case because there were multiple nexuses that OFAC pointed to, but one of them was the fact that there were U.S.-based servers involved in the services that were being provided to SDNs located outside of the United States. So that is also something to keep in mind, especially because we're talking about Fintech and Regtech today. I would also point out that in a lot of cases, you may have counterparties, they might be other financial institutions, which are imposing requirements through contracts and their terms of services, which might require you to do that screening for OFAC or to comply with certain U.S. sanctions. And so you should also be mindful of your contractual obligations, even if you don't have a regulatory obligation to OFAC directly. And finally, I think since I'm in Hong Kong and since Vincent mentioned secondary sanctions, I would also bring up the example of the Hong Kong Autonomy Act. That's where there is a threat of potential secondary sanctions on financial institutions that knowingly conduct significant transactions with certain individuals that have been identified by the State Department in a report that was issued several weeks ago. If you're not concerned with U.S. sanctions and you're not screening your customers, you wouldn't necessarily know that you're exposed to that risk. So I think that's a key reason why you would want to have a compliance program that incorporates those requirements so that you can be aware of this risk which might exist in your business, even if it's not front of mind all of the time.
Thanks, Nick. This is a really good, smart tip. So as a bank, I think we need to be very mindful on the extraterritorial applications of the U.S. sanctions when you have like applications located in U.S. or you have the footprint or nexus or business or counterparty contracts in the U.S. So I think as a bank, this is really a good, smart tip for us to be mindful of. So the other questions that I have in the panel is something to Alex as a crypto custodian. So this question is around KYC and onboarding screening. So as I know that some of the banks banned the cryptocurrencies as the AUM when they onboard the clients because the pain point is that it is hard to screen, hard to evaluate, and hard to understand what's the income or the background of the AUM from the cryptocurrencies. So as a crypto and digital currencies custodian, Alex, where do you see these hurdles, and do you have any suggestions so that in the future banks can have some more smart solutions to overcome the hurdle instead of just a complete ban to accept it as an AUM?
Sure. So I think the banks are victims of their conservative approach to compliance, which is understandable based on their historical build-up, I would say. I don't think crypto are more dangerous to handle for banks or for companies like us than money. Actually, I believe it's the opposite, and it will become even more the opposite when we implement regulations such as that are involving the implementation of Recommendation 16, as I shared earlier. Why do I say that? In the crypto space, for most coins, and I'm not talking about the private coins, which we don't onboard ourselves on-chain custodian because they are too anonymous, but for most digital assets or virtual assets, there are tools out there to completely monitor transactions on the blockchains and have a very clear, if not complete, picture of who we receive the coins from in terms of wallet addresses, whether those wallet addresses have been tainted by previous transactions, and so on and so forth. And of course, beyond that, we onboard customers like we would onboard, like banks would onboard them, meaning we screen, we do full KYC with them. That includes source of wealth, that include questions like that if necessary, based on our risk-based approach. And at the end of the day, honestly, we are quite comfortable onboarding those customers when we have all the when we've done all the screening that we had to do, both on blockchains and the addresses where they hold their coins, as well as their names and company names and so on and so forth, because of the transparency that the blockchain offers to us.
Great. Thanks, Alex. So we seem to have running out of time, but we still have a chance to have one last question from the panel. Okay, so this question I will open for our Eric from Moss Bank to answer. As you know that in Hong Kong we have 8 virtual banks, and then now is the initial stage to starting the business, and we can see a lot of marketing pitch and advertisements. And as a compliance officer in one of the virtual banks, do you see there's a lot of pain points when you starting the business and also starting to adopting the current regulatory requirements? What are the main pain points for as a compliance officer in the Hong Kong virtual banks? Eric, over to you.
Okay, thanks, Katrina. So if you're talking about screening, so one of the pain points for us is how to get enough data as soon as possible so that we can deploy the machine learning. Because as you know, all of the virtual banks in Hong Kong have launched this year. We definitely have no enough data for us to justify ourselves on using some advanced solutions like machine learning or data analytics or some AI stuff to help us to discount the alerts automatically. Because as you know, we need to have a strong data or adequate data before we make the decisions to deploy. So I think this is one of the pain points for us. So it takes time, I know, but then if we want to move quickly, I think maybe it is one of the questions that we need to think about, how we can move quickly so that we can deploy the machine learning or auto decisioning on screening alerts as soon as possible. This is one of the pain points if you're talking about screening. Another pain point, but it's not related to screening, but it's for the general regulatory requirement are, as you know, we need to onboard the customer remotely. So basically, we cannot see our customer face to face. We have to leverage the technology provided by the vendors, external vendors, or built by ourselves to onboard the customer. So throughout the whole e-onboarding process, we have to authenticate the Hong Kong ID or the identification document. We have to use the technology to do the facial matching, and we also need to do the liveness check as well. So all of these are required to do through the onboarding process. But the issue for us is what exactly we need to check on the Hong Kong ID, for example. As you know, there are so many security features in the Hong Kong ID. Do we need to check every single security features through our technology, or we can skip some, or we can use the risk-based approach? This is something that the current guideline has not really stated very clearly, because the current guideline say we have to authenticate the Hong Kong ID, we have to verify the Hong Kong the identification document of the customer. But how far should we go? One of the key questions we always face is, shall we need to also check the micro-printing? Micro-printing is one of the security features on the Hong Kong ID. Check the micro-printing of every single Hong Kong ID. If I cannot see the micro-printing during the onboarding process, can I still onboard the customer? Something like that, because we don't know how to draw the line somehow. So it is one of the I think pain point in the current regulatory requirements for the virtual banking. Thanks.
Thanks, Eric. I think these are all good lessons learned for virtual banks as a whole, and also for those traditional banks if they want to starting to move into the digital operations. So thanks again. This marks a very perfect ending for our webinar today. And thanks again for our honorable panelists and speakers for sharing the great idea in today's section. And also thanks so much for Fintech Association of Hong Kong and Accuity to organize such amazing chances and platform for us to share. So we hope to see you all in the near future and hope to have more similar webinar and panel discussion in the near future. Thank you.